Greetings to all. So once again I am very happy to meet you all through this video lesson on the topic capital gains. I am happily introducing myself as Dr.K.J.Sunmista from the Department of Commerce of the Great SFR College for Women, Sivakasi. My topic for current video lesson is capital gains. The learning objective of this video lesson is to describe the various types of capital assets and capital gains, and then how to compute the taxable capital gains. Introduction. The term capital gains refers to the increase in the value of the capital asset and when it is sold. A capital gain is the increase in the capital asset's value and is realized when the asset is sold. A capital loss is just the opposite. When there is decrease in the capital asset value, it will be the loss. Any income derived from the capital asset, whether it is movable or immovable, is taxable under the head capital gains of the Income Tax Act 1961. The capital gains are broadly categorized into two types. One is the short-term capital gain and another is the long-term capital gain. Capital gains apply to any type of asset, including investments and those purchased for personal use. The gain may be short term if it is of the duration of 1 year or less, or long term for more than 1 year in the case of securities. In case of other assets, the duration is for short term capital asset it is less than 3 years, and for long term capital assets it is more than 3 years. It should be held by the assessee. Here are some examples for the capital assets: building, land, houses, vehicles, mutual funds, jewelry are few examples of capital assets. To give further clarification, the following are not included under the capital assets: any stock, consumables or raw materials held for the purpose of business or profession. Our used clothes and furniture which are used in home, that is for personal use. Land for agriculture in any part of rural India. Special bearer bonds, gold bonuses issued by central government, gold deposit bonds. These are all not coming under purview of capital assets. Now let us see how to calculate the short-term capital gains. Simply 3 steps are involved in that. First, we have to determine the full value of consideration. Then from that we can deduct the cost of acquisition and the cost of improvement, and the final amount will be termed as the short-term capital gain. In the case of depreciable assets, then also any gain from the sale of the asset will be treated only as the short-term capital gain. Here the duration will be not given much importance. So for the depreciable assets, the gain calculated will be termed as the short-term capital gain. Then next let us see to the computation of long-term capital gain. Here also first we have to determine the full value of consideration. We can deduct the following expenditure in connection to that transfer. Indexed cost of acquisition and indexed cost of improvement can be deducted from that. The resulting figure will be the long-term capital gain, and from that some exemptions are provided under section 54. The deductible expenses from the total sales price in case of house property are any brokerage or commission paid, the cost of stamp papers, the travelling expenses incurred by the transferor at the time of transfer, then the expenses incurred for getting the succession certificates, the cost which is paid to the executor may also be allowed as the deduction. In the case of securities, also we can deduct the broker's commission, the selling expenses and all. The only thing that we have to note is the security transaction tax paid is not allowed as a deductible expense in calculating the sales consideration. Here is the procedure for calculating the indexed cost of acquisition. Based on the cost inflation index, the indexed cost is to be calculated. The base year to be taken is 2001 to 2. Likewise, the indexed cost of improvement is also to be calculated by giving significant importance to the cost inflation index of that corresponding year. Here I have given an example. In this example, a land is purchased in the year 2006 for rupees 84,000 and it is sold during the previous year for rupees 10,10,000. The brokerage expenses paid is rupees 10,000. We are asked to calculate the taxable capital gains. See, the full value of consideration is taken here, and from that the deductible expense allowed is brokerage, that is deducted, so that the net sale proceeds comes around 10 lakhs. From this we can deduct the indexed cost of acquisition because the land was acquired in the year 2006 and it is sold during the previous year. So the indexed cost of acquisition is calculated by using the formula given in the slide. So using that, the indexed cost of acquisition is calculated and it amounts to 2,27,902. Thus, the computed long-term capital gain is 7,72,098. If suppose cost of improvement is given in the problem, then that also to be indexed like this and the capital gain is to be calculated. Thanks for watching the video, and in the next session we shall continue with what are the exemptions that are available from long-term capital gains. Till that, signing off, Dr. K.J.Sunmista from SFRC.